liquidity available and collateral available in the financial system. No matter how, I guess it's kind of difficult to understand, and I totally get that because believe me, it took me like 6 hours just to wrap my head around it. But if you think about something like the stock market, okay, you just think that everything is fine and that you got people buying and selling, but it's like nobody seems to be wondering where do these people are actually getting those money in order to buy and sell at that specific type of leverage. Okay, uh, and not all of them, but a good chunk of them are actually financing and refinancing the money that are putting in as collateral through repo and reverse repo facilities, right? The point is that when you get some sort of a turmoil in that specific type of market, it has a ripple effect because um, to put it simply, let's say, I mean, I guess we all trade Bitcoin, right? I guess we all do, and or at least we all did in the past. Okay, now let's say all of a sudden you got your funding rate and it's, let's say, neutral, 0%. What happens if you wake up tomorrow and your funding rate all of a sudden is 8%, and price is not getting anywhere? So you're paying to earn nothing because price is just stuck.
Yes.
So now imagine that, but amplified by the leverage you actually put on. The cost of the, that you are paying to maintain your positions open, it's so astronomical, like in the snap of a finger, that you are forced to close down your positions, or you really risk to get margin calls, not from the broker which are allowing you to have positions in the stock market, but from the brokers or the clearinghouse where you went in order to finance that position. You follow me that?
Yeah, absolutely.
So it is all a matter of, it's delicate balance in between collateral and actual money, cash that you have. And by the balance from that equation, you then have the margin that you need to put on in order to make transactions and businesses and trades in other markets. That could be stock market, commodities, crypto, whatever, right? But the core problem is always, how do you get your money? How do you maintain and guarantee the margin you're putting on for those positions, right? And what is something that could influence that, and the cost that you have to sustain in order to guarantee yourself the margin that then you need to put on to keep those positions in other markets open, right?
So basically, this just pushes the market into more liquidations or to liquidations if people cannot just keep up with the margin cost.
Essentially, yeah, it could be, because all of a sudden, if for you it's getting really, really expensive to put on a position, because the margin you put on, you actually, well, essentially borrow it, and the interest that you are paying on that borrowing operation, it's getting so high, and the price on the operation that you are actually financing with the first operation, right? If you're not making huge returns on the secondary positions, right, you're forced to close them.
Not bullish.
Well, yeah, and again, it's the same that happened in March 2020. It was not about a pandemic, because I mean, if you have been in the markets long enough, you should know that usually, and March 2020, the pandemic was out for like what, 3-4 months then. So you would expect that it was priced in, right? A normal person would think, yeah, okay, we know there is a pandemic going on and probably it's going to spread out, but then why the market in the US are crashing right now, like 3-4 months after the fact? Well, it wasn't about panic. It was just about a collateral shortage, right?
So when you talk
There
about
was not enough collateral.
the interest rates and the funding rates, what are you talking about specifically? Are you referring to the federal fund rate or the overnight repo rate, or are those two things that are
Yeah, the
essentially synonymous?
well, basically they are connected, but they are not synonymous. You have the federal fund rates, and then you have the overnight repo or reverse repo rates. They're usually tied, right? But they're essentially two different things.
Yeah.
What I'm referring to is actually the overnight repo rate. Yeah.
Okay, but that's directly modulated by the federal funds rate, right? Which is typically what
Yeah.
people are talking
Exactly.
about when they're talking about the macro and they're talking about the Fed
Yeah.
and the Fed raising interest rates, right?
Yeah.
So I'm just trying to, for people
Abs-
listening, just trying to connect the two. Yeah,
Yeah,
so
absolutely. They are connected. Yeah. And, the federal fund rate is some sort of a tool, if you wish, that the Fed can use in order to put a floor or a roof on the repo rate, if you understand the logic. Because, you know, what happened is that if you got excess reserve or treasuries, right, you can decide either to hold them and get what the Fed would pay you, which is expressed by the federal fund rate, right? Or you can go out on the repo and see if you can get a better deal, right? Now, normally these two rates are kind of tied and close together, and usually that happens where the the conditions are kind of balanced in between cash and collateral available on the open market. When you see these two rates and the spread kind of diverging a lot, that is a symptom of an imbalance in between cash or excess reserve or bank reserves and actual bonds and treasuries and T-bills and whatnot. If you remember, during the March 2020, we still had the QE program going around. And in that specific period, there were the, I guess, one of the, there was one of the period where the Fed were actually buying a huge amount of short-term treasury, like T-bills. So you found yourself in a situation where the entire system were scrambling to get that pristine collateral. And the point was that there was an obscene scarcity of that because the Fed was actually buying it all up. So there was no collateral available for the open market. And that's where you got that liquidity event, because everyone wants that collateral, and that collateral is not available because guess what? The Fed has actually removed that all from the market, you know?
okay. Yeah, so I just want to bring the topic back to interest rates because that seems to be what everybody's talking about. You know, the Fed is raising
Yeah.
interest rate, has signaled to raise their, raise interest rates on the federal funds rate, which ties into what we're talking about. And I just
Yeah.
want to get the specifics out there for, anybody who's interested. I think the number I've heard, and I don't know exactly, but I think the Fed has signaled to the media that they're intending to raise that rate by nine different times over the year. I think that's a number I've seen, but I can't confirm it. But it's probably somewhere around there. I don't know if you know the exact number, but
Oh, no, but I guess it should be pretty close. I mean, if it's not 9, it should be 7 or something like
well,
that. Yeah.
that is an important thing to know if you're trading this, because like, and again, I'm not trading this. I don't think you're trading it either. But if you are trading this type of
Oh, no,
news,
no.
like, you would want to know that, right? Because then, if the Fed comes out and says, say the number's 9, and the Fed comes out and says, we're only raising interest rates 7 times this year, that's extremely bullish news because the expectation of the market before he said that was 9.
Yeah, in a
So
sense, yeah, yeah, yeah.
yeah, so
Um,
that's important to keep in mind. But specifically, I think so. My understanding of it is that there's the Fed has signaled their intention to raise the federal funds rate by 25 basis points 9 times over the year. So you're looking at essentially a 2% rise in the federal funds rate.
Yeah.
And it's important to contextualize that and where the federal funds rate is currently, where it's been in the past. So like right now at the current time in the market, the funds rate is at a historical low, right? So raising the interest rates up to 2% is something that has happened in the market before. Again, I wish had data in front of me to look at it, but I want to say that over the course of the last 10-year bull market in stocks, 12-year bull market in stocks, I'm pretty sure the federal funds rate has been over 2% several times. So I think it's important to contextualize it because the market, we've seen that in the market before, and you could go back and see how the market reacted during those time periods.
Yeah. Yeah, I think it's very interesting, and surely it's good to know that, especially getting back to the past and looking at what happens and how it played out in the past. The only thing I would add is that I think a lot of people are actually laughing at the Fed right now because they're kind of on the side that, yeah, you've done it before, and we know how it ended up. Yeah, you had to reverse course, getting back to QE infinite, and the stock market just went parabolic. Absolutely, I guess that is a fair point. The only thing that is different this time around is inflation. Because if you look back at what happened after 2008, so the great financial crisis, we never had this type of inflation. So my only concern would be that this time around, maybe it's like the Fed will actually not guarantee the market the infamous Fed put, right? Because inflation is something which is not only financial or economic related, but it's also politically related, right?
Yeah, no, it definitely is. It's hard to know exactly what they will do, right? I mean, it's that's really difficult to predict, at least in my
Oh
opinion.
yeah,
And I would
absolutely.
make the argument
No,
that
no,
you know all we have to work with is what we have two different things, right? They fall into two different categories. We have what the Fed has said they will do and what they've actually done. And those are the only two categories that represent,
yeah,
well, they're different categories, but they're both important in different ways. But there's a lot of things that don't fall into either of those two, right? Things that they haven't said they're going
yeah,
to do and things that they haven't actually done. And I would describe everything that doesn't fall into those two categories as narratives, right? So it's very easy to like
yeah,
look at the situation, put yourself in their shoes, and logically go down the path of like, well, if I was Jerome Powell, I would do this, this, and that, and then to
yeah.
create a narrative around that they'll do that. And
And
I think that's an error, especially if you're going to trade that type of, you know what I mean? Like that's just an
I
opinion,
mean,
So
I just think you have just touched on a huge point, because that is true. You can only work with what you think the Fed will do and what the Fed will actually do. But I guess the point in the middle is the more important. It is the most important, because if you really start to dig in deeply, especially in history, you realize pretty soon that there is not so much they can do. And as you were saying, the narrative counts more. Let's just put it this way: the Fed cannot actually do a lot of stuff because the toolkit they have, it's kind of limited, right? So the way I see it, it's that most of the times the Fed, or Jerome Powell in this case, or who came before him, they are actually going live on stage and TV, telling the people or the public or the investors or the market participants in general what they are what they intend to do, and they hope, keyword, they hope that the market will actually do their job because they cannot do that. And that's a very subtle nuance, but it's very important in my opinion.
Well, so there's, you know, so you're talking about, it's hard to not talk about inflation when you talk about what they will do with interest rates. And everybody has a different opinion about inflation, and everybody thinks that the Fed will react to it differently, or at least according to how they, they perceive the narrative to be. And
Yeah.
I'm just trying to play devil's advocate and say that it's very
Yeah, I
difficult,
know, I know.
difficult to predict what exactly they're going to do, right? Even if they've signaled their intention to do a certain thing, right?
Yeah, yeah.
It's
I
and
mean,
then and
I, I think we are both on the same side when we say that we don't know what they're gonna do, right? I guess nobody can predict that. As many other things in the market, nobody can predict that. But I think if you look back at history, there are multiple occasions where they told they were about to do something, and history showed that they weren't able to do that, and they didn't, right?
yeah, well, the other thing where, so that is a very important point, right? They do pivot often, and when they do it pretty
Yeah,
dramatically. But the other thing is that, a lot of what they say is they're saying things to get a reaction out of the market. You know,
yeah, that was
Peop
exactly my point from before.
yeah,
Yeah, yeah, yeah.
yeah, and people call it jawboning or whatever, but the sometimes a lot of times what they say is designed to get the market to react, either negatively or
Yeah,
positively. Yeah.
I mean, if you, I guess we got it's some sort of a deja vu because we already had this type of conversation in the past. But if you remember, when I was talking about QE and why QE didn't work in the way the Fed were actually thinking about it. Um, the common belief is that QE was inflationary, right? And then again, you see that they got QE1, QE2, QE3, and they never reached the 2% inflation mark. But they were going on TV saying, you know what, we got the inflation expectations and whatnot. So the way I see it is that they knew that they couldn't get inflation. But if they go out on TV on stage saying that they are expecting inflation, I guess the best hope they had is it's kind of spurge the market participants to behave like they were expecting inflation. And so, what do you do when you expect inflation to rise? You spend now. And what do you do if you spend now? You are actually provoke the inflation the Fed is trying to achieve, you know?
Yeah, well, I mean, we do have massive inflation, so it's not like
Yeah, right now.
I think.
Right now, yes, but not because of the Fed. Absolutely not.
So is the
you
Fed
know?
really saying that they haven't hit their 2% inflation target? I mean, maybe I'm misunderstanding you, or I don't know, but
No, no. What I mean is that if you look at the past decades or 15 years, right? They always set a target for inflation at 2% because it was kind of that sweet spot they wanted to achieve. But no matter how many rounds of QE they did, it's like inflation never starts to pick up, right? But they were keeping on getting out to the public saying our inflation expectations are actually higher for next month, next quarter, whatever. And I think you know they knew from scratch that by the toolkit they have, they weren't able to actually spurge inflation. Because if you look at what the Fed is capable to do, they're actually designed to fight inflation, not to provoke that, right? So the problem for me is that they have tried so many years to spurge inflation, and now that they have inflation, they think they've done a great job. When it doesn't have anything to do with the Fed. The inflation we are seeing right now, it has a lot of different reasons, like supply chain disruption, energy crisis, the war in Ukraine, whatever you want to put on. But it's not due to the Fed, in my opinion. And I know it might sound kind of silly or maybe bold or maybe whatever you wanna call it. But I do really think that the inflation we are seeing right now, both in the U.S. and in Europe, has nothing to do with monetary policy or central banks.
Wait a
Are you?
minute.
Yeah. Are you?
This is
Are
a
you
very big
trolling me
statement you
right
just
now?
said.
Like I feel like I'm being trolled.
Way exactly. No, 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 no. But I understand where you're coming from. I understand where you're coming from. But I think this is a good topic to discuss. My understanding is
Yeah,
that
wait, I do know that TradingView has a limit of 20 minutes. So if you wanna start a new one before you
No,
got we go
I'm
down
doing
to.
OBS, so we're good to go.
Oh, okay. So we are covered.
wonderful.
Okay.
So, okay,
Yeah, I
so
kind of dropped a bomb there.
so my understanding, and correct me if I'm wrong. Again, this is a very simplistic way of looking at things. That most of our current inflation was created through the artificial creation of debt, meaning by creating very, very, very cheap debt to stimulate the economy during the pandemic, increasing the monetary supply by a very large percentage was one of the root causes of the inflation. Because, like you said, we do have problem with responding to demand, but you have created an artificial heightened demand by creating such cheap debt, and you wanted to create very big demand because you wanted to avoid recession during
Yeah.
the lockdown.
Yeah.
But
I
now what
mean,
happened is that the
Well,
money is in the markets, and what the Fed wants to do is that they want to cut the supply, and they want the debt to be paid back to remove the monetary supply live in the market. But they
our
are playing
yeah.
a game of what crashes first, the
okay. Well,
government
first of
or big
all,
Yeah.
corporation.
so
It's a good it's a
they're
good
not
point.
they're not going to lower the money supply. The money supply is going to continue to increase. It has continued to increase. It's not going to stop. It can't stop.
No,
And
no, it can. It definitely can. It definitely can.
the money
It
supply
definitely
can
can.
stop increasing. Well,
No, no, no,
so
no. Okay.
Well, it depends on the time horizon you're looking at, right?
So
It could
example.
decrease in 6 months, but it won't decrease in let's say a decade, right?
So look, the money supply was increased via debt. But if, so let's say me increasing interest rate, there's less chance that people want to take debt or corporations or government. Government is
Yeah.
a different animal. Let's say just government is a little bit different. Let's stick to people and corporations. But all debt has a date where we need to pay it by. So, mortgage 25 years or 30 years, credit card has a specific amount, and so forth and so forth. But if I have more debt being paid than new debt being taken, there's a negative impact. Well, there's a positive impact by reducing my total monetary supply.
all right,
Does that
Roman.
make
So
sense?
no, if you repay debt, it doesn't reduce money supply. That actually increases the money supply, because think about it this way: like if I'm a bank and a major banking institution, and I
Sure.
issue you a private loan, that's just money. That's new money supply injected into the economy, right? And that, but it only, you have to pay that back, right? You have an obligation to pay that back, but your liability is the bank has created a loan that they're creating money that didn't exist in the economy previously.
Yeah. So
See what I
basically, when you
mean?
have
So,
credit, when you have
so
credit expansion, you have new creation of money. When you have credit which is paid back, you have money destruction. Yeah.
well, you don't have monetary destruction, right? I mean, the money is still in the economy, right? It's just you have transferred it to the bank with interest, so you haven't
No, no, I
destroyed.
understand what you mean, but okay, I understand what you're saying, but you're taking a very simplistic example as of a credit card debt. But let's say myself, I wanted to buy my condo and I needed $500,000 from the government or from the bank. I apologize. The likelihood of someone fully paying their mortgage is more. It's rare. Why? Because you want to sell. You're going to sell your house. You're going to sell your condo because you want to move, change, whatever, so forth, so forth. But by myself asking from the bank $500,000, I have artificially created half $500,000. But when I
Yeah.
sell it, that half a million is going to disappear. Well, a chunk of it, because I'll pay back some of it as a loan, as paying back my debt, but a chunk of it will disappear. So I understand what you're saying from a
why would it
credit card per
disappear?
se,
I don't understand that
because
point.
It depends how. I mean, if you sell your condo, I mean, if you sell it to someone else, it's like you're basically passing the debt to someone else, which is buying from you. So unless someone step in, and pay off the debt entirely, you don't have money
Yeah, but I'm
destruction,
not.
right?
The missing piece is the destruction of the monetary supply, right? It doesn't, right? If the money just circulates within the economy, that's not destruction, right? The lending and the credit expansion is the injection of new money supply, and then paying it
Yeah,
off or
well,
transferring the debt to
it's
somebody
just
else.
I
You know,
think it's just the opposite principle, because if we agree that when you lend money into existence, you're actually creating new money out of thin air,
yeah,
right? Because you create a debt and a credit, right?
yep.
So when the debt is paid off, the credit again disappear. So they balance themselves. So they even themselves out. So at that point, you really have money destruction, because if lending out money into existence is money creation, if you pay off the debt, that's money destruction. Yeah.
But it's not monetary destruction. And I'll illustrate it this way: like, if I'm Morgan Stanley and I issue, $1 billion in lines of credit to different people, different organizations, and they all pay it back, they haven't destroyed $1 billion. That $1 billion is still in creation, still in the economy. I still have possession of it. I can still spend it. It's increased the money supply. So
no,
yeah,
I understand exactly what you mean, Anthony. Okay, that's a very valid point. I'm actually okay. So I do believe what you're saying makes sense in the most simplistic things. But if you look at, let's say, Morgan Stanley, like a big entity, what would that still apply? So let's say a corporation took, I don't know, $500 million debt, pays back that money, and then Morgan Stanley decides to buy foreign bonds. Does that money still apply to the current monetary supply, or we have to consider the world monetary supply? So that's another thing that we need to maybe
It
take into
depends.
consideration.
but the
Where
point
is the
is
money kept?
the point is that it's expanding the money supply. It's creating new money, right? It's not destroying any money. I'll give you an example, right? Like, uh, and I'll use Morgan Stanley's example just because I'm familiar with them. But if you Morgan Stanley is starting to issue Bitcoin-backed loans, right? So you can collateralize a loan with Bitcoin. Now,
Sure.
think about it in that terms, right? If you were to say you had a loan, right, and even say you defaulted on the loan, you didn't even repay it, right, and people laid claim to your Bitcoin, would that just take away from the monetary supply of Bitcoin? I mean, even in an
Well,
event of default,
surely it
it's
would
not.
take away from balance sheet, because you would have like defaults or bankruptcies. It's what Ray Dalio describes as monetary creations and destruction. When you have debt restructuring, sorry, that is a way where the system is deleveraged.
Yeah, it's a deleveraging event, definitely. I mean, if people are, you know,
Yeah, but I
yeah,
mean, if you think about the dynamic, if you have, during the phase when you're putting up leverage and when you are expanding leverage, you have monetary creation. If you have a deleverage event, you have money destruction, which is essentially people going bankruptcy.
yeah. Well, I mean, if so, yeah. So, but those are two different things, right? If you have an event of default compared to repaying a loan, if you issue $1 billion of loans and they all get repaid, you just created $1 billion more in the system. Now, if you have a loan that, you know, say you issue $1 million loan and they default on that, well, technically, so you haven't gone below zero, right? Because by issuing the loan, the $1 million loan, you created $1 million that's now in the money supply. So maybe they pay off, say they paid off 30% of the loan and then they defaulted. Well, do you describe that as taking money away from the supply? But if your framework of perspective is from before you created the additional $1 million, right? Even if they default after paying 30% of that,
Yeah,
that's still an
yeah,
injection of three hundred
I
thousand
got.
dollars into the money.
Yeah, I finally got it. Yeah. Um, what I would say is that from a nominal standpoint, or if you look at, the old method from a balance sheet standpoint, yeah, those money would remain on someone's balance sheet, of course. But if you look at the actual money in circulation, well, those money are gone. They need to be write off at a point.
Well, yeah, I mean, the thing is like, if you have a massive credit contraction event where people are, deleveraged, and then the next thing that follows that is a credit expansion event, right? Because, like you said, the money supply needs to be replenished, at least to keep the system going.
Oh yeah,
You know what I mean?
unless if you want to have a financial crisis, yeah, someone has to step in and bail out the old matter.
Yeah.
Yeah,
So it's an example of how like,
Usually it's the government.
yeah, it's an example of how like, even after like these massive credit contractions, the money supply is still basically right by all-time high. I mean, it's not really, you know what I mean? I
I
mean,
guess no, yeah. I mean, I think I got your point. The problem for me is that the only way I can see that is the way by which you define the money supply, because there are a lot of different type of definitions, right? Because we have M1, M2, and every now and then they kind of modify what is included in M2 or in M1. It's like CPI, right? They kind of modify it to serve the different needs they had. But yeah, I get again. I think the logic you're putting on is absolutely right, but it always comes down to how you want to see that. And of course, every single entity or every single subject into the financial system are gonna, use the definition that suits their goals better. I think, and that's one of the beauty, and at the same time, uh, the
so
ugliness of our financial system. Yeah.
yeah, I mean, I would just simplify, you just, inflation is just the expansion of the money supply, or put it a different way, right? You can't expand the money supply without creating inflation. It's not possible. They think they can do that, but that's actually not possible. The only way to do that is to create an artificial basket to measure it. And so yeah, so you know, really,
Yeah, man.
it's like,
Yeah. I get that. Yeah,
but
and
yeah. So the
yeah,
thing is, like, basically where we're at is, and I think this is an important distinction, right? Like, even if interest rates do rise, like the federal funds rate rise, it's not like the monetary supply is going to decrease, right? It's still going to increase, despite a rise in interest rates. And I think that's something that people get confused. They think that a rise in interest rates means that the money supply is going to stop expanding, and
It's going to start expanding at a such rapid rate.
it it's going to. Sorry, I missed that part. What'd you say?
It's going to stop expanding at such a rapid rate by increasing the interest rate.
I don't necessarily know that one leads to the other. I mean, yeah,
well, I guess people use one measurement for that, which is the Fed balance sheet, I guess. But I'm not sure it's really everything there is. But a lot of people like to look at it, and if you look at it, it's keeping going higher. So yeah, it could be a point. Yeah.
yeah. I mean, the federal funds rate is compared to where it is, typically historically, right? Like to put things in perspective, right? It got up to like 20% during the 70s, and right now
Yeah,
it's
yeah.
right now it's
That was the
40.
the Volcker period, right?
Yeah, right now it's at what
Yeah.
point 0.5, so it's 40 times lower than the 70s. So that just
And
kind
you
of
have a much bigger amount of outstanding debt. Yeah, absolutely.
so
Substantial.
I just think
So it's even worse.
the perspective is important on that because you know yeah, it's just they are raising interest rates, but interest rates still remain very low
Yeah,
compared to any time period. I mean, the interest rates are
exactly.
still low. Like,
I mean, it's like
they're-
if you wanna put it simple, right? For the audience, it's like let's say you owe me $100, right? And I told you, like, okay, I'm gonna lend you $100, but you need to pay me 2% interest yearly. Okay, you might say, well, it's no big deal. Okay, I'm gonna do that. But let's fast forward like 30 years, and in 30 years, I'm gonna tell you, okay, now you owe me like the same uh, $100, but at that point, I'm gonna charge you like 7%. So you can see that it's completely different.
yeah, yeah, definitely. I mean, so I think another thing to kind of clarify is like, maybe you are formulating like your your portfolio based on what the Fed is saying, and I think that's you know very relevant, especially if you're early to it. I mean, if especially if you were
Yeah,
smart enough back in November when the Fed started pivoting to start hedging, and start trading that direction, like that's pretty good. But like, okay, so just hypothetically, say you just walked into the market today, and you just so your first time in the market, you have to just operate with what the current conditions are. So maybe the Fed expects 9 interest rate rises over the course of the year. We've already actually seen one, right, in the last meeting.
yeah,
So
yeah.
so you got to distinguish between what's already happened and what we expect to happen. So we've already seen a 0.25% rise. I think we expect a 0.5% rise next week, and then
Probably, yeah.
and then six more 0.25 rises to come in the future, in the rest of the year. So if you're going to trade that, how do you trade that? Well, the only way to trade that is to understand what the expectations in the market are, right? So, if next week comes and it's there's something different than 0.5% interest rate hike. Say it's 0.25 would be extremely bullish, 0.75 would be
Yeah.
bearish as well because it
Oh,
would be exceeding expectations. And then any change to the 9 forecasted interest rate rises for the rest of the year. Um, yeah,
but my point would be, of course, you're trying to forecast what the Fed is about to do, or what they are actually capable to do. And to that point, I would say one thing is listening to Powell saying that we are going to do this and that, and the other point would be, okay, how much can you can you do that before actually breaking something? And getting back to the point that the whole matter, it's of course financial, economical, but also political. And don't forget, I mean, you're gonna have, I guess, midterm election in November, right?
yeah,
So I mean, from a from a political standpoint, right? It's not a very good position to come into an election having CPI at 8.59%, because basically you are the political force which has bring American people to basically uh, have lost their purchasing power, right? So do
yeah,
you think
yeah.
that the people are going to vote you?
Well, this is what I mean by like, you know, it, like that sounds like it makes a lot of sense, right? But like actually, the midterms are coming up in November, so you could, uh, maybe next month, like inflation takes a while to hit the the markets, especially the markets where, you know,
Yeah, it's a very lagging.
yeah, in my
Yeah,
experience, in my everything I've looked at, it takes about 8 months, right? For if you have like the COVID
yeah, yeah,
stimulus
yeah.
program,
I agree with
and
you.
you,
From 8 months to 1 year. Yeah,
yeah, and you can see that in the Bitcoin market, right? So you had your low of 2020 in March 2020, and yeah, Bitcoin rallied off a low, but it didn't really start to break out and create that parabolic rally we saw at the end of the year until
yeah,
about 8 months after that massive
yeah. It was
injection.
January, I guess. Yeah,
Yeah, so what I'm saying is like you could really get away with a massive injection of liquidity in the markets right now without it really affecting inflation before the midterms. So that it's a good example of like how you know think it doesn't things
no,
don't
no.
always. It's a very
Uh,
complex system, and
yeah, I
it's
mean, yeah. I guess it's in order to try to kind of forecast those type of things and actually making out a trading plan. You need to put on a logic which involves four dimension because it's really complicated. Absolutely, yeah.
yeah. I think the thing that's most tradable is the expectations that exist around what the Fed's doing, right? Um, yeah, I think that's the most important. If and you'll always be in a situation where maybe you are, maybe you are bearish and you're kind of expecting, uh, a market sell-off or some type of credit contraction. So you're gonna find yourself in a position where no matter what you do, you're always thinking, well, the Fed could come out at any moment and raise interest rates, which they could. I mean, they could at any like Fed Powell could pick up a phone at any moment in time and call the media and say, hey, by the way, we're actually going to change our the interest to we're going to up it from point 0.5 to 0.75 next week.
Oh yeah,
I mean,
he
he could do
could,
that
he could.
he could do that at any moment. But the
Yeah,
problem is like that doesn't represent an actual piece of information. That represents a fear or an emotional thing, right? I mean, so you can't work with that, right? It doesn't exist.
yeah. The problem is that I guess we basically started out in the same camp, and so we should be particularly familiar with the point that expectations are made to be unmet most of the times, and it's very dangerous to trade on expectations
Yeah,
because you never know, right? And most of the times, if you trade based on expectations, you're gonna find that either you are too late, or either you underestimate or overestimate the effect of a particular announcement because you never know how the market will price in the expected new, right? It could be in advance, or it could be late, or and you cannot quantify in advance the magnitude of the way the market will price that in. So trading off news, it's always very difficult. So we try to come up with different data points or point of reference on which we could build up a solid edge statistically, right? But again, I agree with you. It's not like just because you got an edge, it doesn't mean that all of a sudden Powell could come up and say, something totally unexpected, and the market could be really overreacted at and basically screw your plan over, right?
yeah. I guess what I'm trying to say is like I think some people in the market, at least in this period of the market, are being negatively affected by their emotion. And they're letting their
Yeah,
emotion make decisions for them that they wouldn't otherwise make. So
Well, yeah, I think so.
You know what I mean? And then they'll lean on certain things that you know validate those emotions essentially. And
I guess the problem is always where you stand because you know uh, it feels to me like you're more, or at least slightly more on the bullish side. Either is Bitcoin or the stock market
yeah,
or
so I'm
whatever.
not. I mean, this is another important point and worth getting into is you know a lot of people are you know they're naturally bullish primarily on the equities market, right? And I don't really have an opinion
Yeah.
on the equities market. I don't, you know,
Okay.
I just don't. I don't know. Like I don't spend enough time in the equities market.
Yeah. Absolutely. That's fair. That's fair.
Yeah, and you know, but yeah, I am extremely bullish on Bitcoin, and despite despite what's going on in the equities market, I'm not really that concerned about it. But I do think there is an argument, you know, for people who, you know, maybe they are bullish in Bitcoin, but you know, they're concerned about what's happening in the equities market, and they think that's going to spill over into the Bitcoin market. Like I get that logic. It's just not something that
Yeah.
I really act on, or you know.
I
I
think
guess.
I think
Oh, sorry.
bullishness and bearishness needs to be prefaced by what's your event horizon. I'm
Exactly. Yeah. I
I'm
was about
I'm
that. Yeah.
I'm very, how can I say this? If we're talking about equity market and we say let's have a 10-year outlook, I am extremely bullish on the equities market because if you look at from inception, it only goes up. It
Yeah.
just only goes up with a few bumps along there. Sometimes it took 4 years, 5 years, 6 years,
Yeah.
but it always goes up. The system is
They
made for it to go up.
the best part of it is that you can validate that bias because you know that you're gonna have currency debasement.
Exactly.
So
Exactly.
it might be a downturn. It could last 1 month, 3 months, whatever. But at the end of the day, if you're yeah, the problem is that if you're pricing in something and the measure tool that you're applying is something that it's always being based. It's mathematical that that's something it's gonna go up in price, right?
Yeah, actually, over the long term,
Absolutely.
yeah.
Yeah, over the long term. So again, I think the point Roman brought up is actually pretty valid because you can be bearish, bullish, or whatever, neutral. It always comes down to the time horizon you have. Now, when
Exactly.
I say I'm bearish on the stock market, and by the transitive principle, I'm kind of bearish on Bitcoin because of the correlation. It just means that I'm very short term. It
There
could
you
be,
go.
1 month, 2 months, whatever.
A
But
quarter.
if you ask me, where do you see Bitcoin or the stock market 10 years from now? Well, I look at the monetary system and I look at the dollar and look at currencies, and I can only tell you that it's going to be bullish because if the measurement tool we are pricing in these assets is always being the base, those assets need to go up in value, you know?
Voila.
Yeah, pretty much.
So
So
if you're a
Exactly.
long-term investor, you should be exposed. Of course, if you're going in like 100x leverage, it could be a problem for you in the short term, right? Absolutely, I'm not denying that. Of course,
Exactly. Exactly.
yeah,
but again,
I think
guys, I mean,
I think
Bitcoin sub 30K. Wouldn't you buy that
I
for the
guess
long term
I guess what I'm
in
trying
spot
to
positions?
yeah, I do. That's what I would do. Yeah, that
Yeah,
I think for
I
most
mean,
people
I've
that
been waiting for like 1 year for that.
for you know I think for most people that just represents the most energy efficient strategy, right?
Yeah.
And should be considered to be the gold standard of returns. I think it will be used as the gold standard of returns, right? So like do you have like how does your performance compare to the performance of Bitcoin itself? And if you're not outperforming it, you're not doing well. And I think that'll be the gold standard. in the future. I think.
But not okay. So it goes back. So that point, I just want to play devil's advocate for 2 seconds and play a bit, which you spoke to
Oh,
me about risk taking and risk management from a trading perspective. Not everyone has the same risk appetite. Now you're going to say, should anyone allocate 5% into Bitcoin? I say absolutely. Yeah, I think it's risky to be 0% in Bitcoin.
exactly. Yeah.
But if you're a big firm, if you're a big corporation, you're willing to play a risk in not gaining as much, but at least you're not risking so much equity because you're looking more for stability. You're more looking for that 5%, let's say a
Yeah.
month uprise, because if
I
I'm
get.
investing 10, 20, 50, 100 billions of dollars,
Yeah, I
5%
get.
on that is immense.
I get that. Yeah. Of course. Of
Well,
course.
that
Yeah.
that
I,
that's only
I,
because of the volatility in the market, right? Because Bitcoin is so volatile that the
Exactly.
solution to volatility is to reduce the position size. But
yeah.
but that's only a function of the volatility, right? If Bitcoin wasn't so
Exactly.
volatile, their allocations would be much higher.
Exactly. Of
So
course.
But conversely, even the returns would be much lower.
exactly, yeah.
So
So
it's
yeah,
kind of a
The catch
dog
20.
chasing
Yeah.
its tails, right?
There you
yeah.
go. There you go. And the thing is, like, imagine you're a father, you have 3 kids, your savings is after 25 years of work, you'd say you've saved up $100,000. I mean, if you put $100,000 into Bitcoin and that thing drops from 60K to 30K, you're not sleeping so well.
Oh yeah, absolutely. But again, even I mean, what I'm trying to say is that when shit hits the fan, no matter what type of market you're exposed to, you're gonna be hit. Okay.
Yes.
So I guess the problem for a lot of people is just trying to come up with the type of investment which could grant them a decent amount of return in whatever time horizon they choose, but expose them to the lesser type of drawdown they can be exposed to. So, I mean, at the end of the day, I think you laid it out pretty well. It depends on the risk appetite. For me as a retail investor, if I got, let's say, 50K to deploy, and I have a regular job, or at least I have a regular income which can provide for my needs, my family, my children, whatever. And if I don't mind to put 50K at risk, even though I know that I could lose, let's say, 50, 60% of them nominal value in the next year, but in the long term, like 10 years, I could have like 3, 4x them. I would be totally agree. I would be totally in line with that. But maybe for some people it's not the same. So it's always a very personal matter, and you don't know what kind of risk appetite people all around the globe will have.
Yeah, absolutely. And again, it also changes from people to corporations into
Yeah,
governments and so forth and so forth. So that's why and I think that's a good thing because that's the beauty of the market. There's no one solution fits all. So you have to kind of
yeah,
find your ways through that. And I think this is the most beautiful thing of intraday trading. And this is why what you guys are doing is so amazing because I think it's such a privilege to not
yeah,
give a fuck where the market is going.
yeah,
Goes up, goes down, up. As long as I have my setups, I'm making money. And I think it's such a privilege. And the more I think about it, it's I don't know, it's for me it's like poetry. While
yeah.
people are worried about this, worried about that, I'm like, I just want volatility or I just want my specific setup and I'm all good.
Yeah, I mean I guess that comes down back to the point of being an investor, being a trader, because I think those are two different sports.
Yes. Yes.
Absolutely. I mean,
Yes.
I can trade, and I do trade every single day on the and on the forex market. But the only investment I have put on is actually only on Bitcoin. So it's different, and I have to treat them differently.
Yeah,
Oh,
I think
absolutely,
if
absolutely.
sometimes you can realize that you're, you know, in a certain stage and you want to progress to a different stage. And I think for a lot of people, that's like, I don't know if you guys have noticed that, like, some people say, well, I can't hodl Bitcoin and trade it at the same time. You
Oh
know,
well, yeah,
yeah,
okay,
I know a lot of people say that. I've heard it a lot. It's pretty common, and I think it's
yeah,
something that affected me as well. But if I think that's a kind of a trading error in a sense, because it's like, well, you know,
yeah. I mean, I think that is a very valid point. It Yeah, you weren't affected. I kind of was in a way. Let's just put it this way. The problem I found, and I guess it's just personal. It was just me. It doesn't have anybody else in the world. But for me, it was like, just because I was holding Bitcoin right in my ledger, um, I was trading it intraday, and the problem I found, and it took me like a decent amount of months, like 9 months, to realize that the majority of my trading errors related to trading Bitcoin, it was that I had this bias that it needed to go up, and it needed to go up because I was holding spot positions. So that kind of a hope, desire, was actually affecting my bias in terms of intraday, trading decisions, right?
yeah, I think if
I
you really dig deep down into that, what you'd find is that it has a lot to do with your cost basis, right? So if you've just recently accumulated a spot position, then you're
Yeah,
mentally very very well aware and very anchored to that whatever that cost basis is of that spot position, and that's gonna
yeah,
fuck with you, right? But the point I'm trying to make is that, like, if you ditch the spot position and whatever, if you just determine, hey, that's not for me, I can't trade it and hold it at the same time, well, you're actually putting yourself further away from reaching the opportunity where you could be in a position where it wouldn't affect you, right? Because the position where it wouldn't affect you is if you have a cost basis that's like from a cycle ago or 2 cycles ago, right? If you
oh yeah, I
if you're
agree, I agree.
if the market right now, the market's trading at 3,800, right? Or excuse me, 38,000, and
Yeah, more or
say
less, yeah.
you have a
I
cost
wish
basis of,
3,800.
yeah, say you're sitting your cost basis on your mental accounting cost basis is at $800, right? You're going to be way less affected by somebody that who's just recently accumulated a position.
Yeah, absolutely. Yeah. And again, it gets back to, timing the market is always better than timing the market. Absolutely. Yeah.
Oh, I yes, that's very well put.
So
Very well
yeah, I
put.
mean,
Because, I mean, if you're playing the long term, yeah.
yeah, I just think it's important to do that for people because if you don't have a spot position, right, you don't really have anything to build on, right? So now, of
Yeah.
course, maybe you hedge your spot position or whatever, but I'm not saying you don't do that, but like,
Yeah. I'm the king of edging. Yeah.
yeah, yeah,
No,
exactly.
but you know what?
I always takes huge swing shorts on Bitcoin nowadays. Yeah.
No, but how can I say this? Me, it was a bit the opposite in a sense. Like it took me a lot of time and courage to hedge my position because, in a sense, like I don't want to play with this. I buy Bitcoin. I only care about Sats, and I don't care about the dollar value to it. So if it goes up, down, I don't care. I just want to buy more Sats.
Oh, yeah.
And that's why for our longest time, even when we're like higher 40s, I wanted to at least hedge a portion of my spot position, and I couldn't find quote unquote the courage. I'm not gonna lie about it. I need to acquire this courage. So as soon as I kind of angled it through the idea that by hedging or having a bit of a short, all I'm doing is I'm increasing my SATS value. So I kind of remodeled the thinking behind it, and that kind of gave me that possibility to again create that hedge. And for people that kind of spend so much time in the markets, I think if you find a certain comfort in your level where you're going to be proved wrong, and the risk you're willing to take by price reaching that level and you're being proved wrong, then I think it's quote unquote healthy to hedge some of it.
Yeah. So
If you,
so
yeah,
currently you had a. I just want to dive down into this a little bit more. So it sounds like you have a hedge on your position. I think last time we talked, it was you're 1-to-1 hedged with a 20% short open on top of it, and
yeah, I read
Yes.
that. Yeah.
yeah. So is that, did you hedge all in one area? What was the cost basis for that hedge?
So my main hedge was at around 41K, my hedge, and around 39K, that's when I added my 20%.
Well, yeah, man. From a technical standpoint, you kind of picked your levels really good.
So you essentially have short contracts open from 41K and 39K, essentially.
Exactly,
Okay,
exactly,
gotcha.
exactly. And I will be taking profit and adding risk on pullbacks, but on higher time frames. So that's how I'm looking at it. Or if as soon as I see a very violent wick,
So
I don't mind removing all of the hedge. But
so
Yeah, well,
what do you mean by that exactly? Like taking profits, adding risks. Like what levels are you
because
looking at, and what levels are you to take profit, and then what levels are you looking at to add risk?
okay, so adding risk will always depend on price reaction. What do I mean by that? I will add risk only when price is going to rally. So basically, I'm that dummy who's going to short the bounces. As soon as there are bounce, I will add to my position sizing. Now, myself, I am definitely going to remove some risk at 37, 36K. Um, this market does not go in one straight shoot, but at
yeah.
the same time, it's really hard to kind of predict all of this. And I do think at the same time, at these levels, sometimes less movement is better. But what could plague me is I am maybe very emotionally attached to the concept that this may spit down pretty violently to the lower 20,000. So there is this
Uh,
anticipation of that
but
occurring.
the point is that you're actually planning to take profits on your short positions, right?
Yes,
Okay, so I mean, of course, it's your choice, it's your plan. Uh, I'm not here to kind of talk you out of that, but I just want to kind of offer a different perspective, if you allow me that.
of course, of course.
So my reasoning would be, you kind of, if you want to look at the old matter like this, you kind of pull on risk on the short side, uh, because you were thinking maybe the market is going down, so I want to hedge my spot positions. Okay, and it totally makes sense. Absolutely, I did the same. Okay, but when I hear these sentences like taking profits, or managing risk, the first thing that comes to my mind is that, adding risk. It's like you're actually pulling off risk, because if you got spot position, you are exposed long. So if you open up a short, you're edging yourself. So you're actually taking off risk. So when you talk about taking
I see what you
profits,
mean.
or
Yes, 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 yes.
yeah,
I
taking profits
understand.
on those shorts, you're actually talking
Adding risk.
about reducing your edge, on the market, right? So I guess the purpose of an edge, it's not about making profits on the short position rather than maintaining the profits that you already made on your spot positions, right? Or am I getting it wrong? Maybe I'm just misunderstanding, because I don't know what you're doing. I mean, it's like I'm trying to offer an opposing view, or at least the dynamic. I see, and I'm trying to understand what you're doing.
So I think I
It's
think
not about talking you out of the trade. Absolutely.
I think the important thing, and I don't want to speak for Roman, but it's one of those things where it's like, show me your portfolio and I'll tell you what you believe. Clearly,
Oh, yeah,
he's expecting the summer
yeah.
2021 lows to be violated. I would assume based on that portfolio.
Yes,
So
yes.
I agree. The money talks. Yeah.
so yeah. So
Yeah, I definitely do, and I think I don't know. You know what?
No.
It's like that. It's like the video I post. Every week, depending on what prop market does, I will definitely reevaluate everything. And I think this is not like I close my eyes and see you in 6 weeks type of things. So we will see
yeah,
how the
I
market
think
reacts. But I do have these expectations that there is a scam wick to be had to very
No,
interesting lows.
no, yeah, well, we are just here to talk about like normal people, kind of in a friendly way. So it's just because I wanted to kind of try to understand what kind of logic you are applying, in order to decide where you're gonna, reduce your short positions or increase your long spot positions, because it's just some sort of a comparison, if you wish, and it doesn't mean that just because you're doing something you're wrong or you're right, or maybe I am wrong or I am right.
so.
It's just about comparison.
I think
I
he
just wanted
mentioned
to
that
understand the logic.
when we were talking before. He mentioned that he would, if I think you said if a weekly high gets violated, you take 25% off, and then if the monthly high gets violated, you take 25% off.
Oh, okay, okay, okay.
So
That I can relate to that. Yeah.
yeah, so I think I don't know if you have other invalidation levels or if those are kind of the main ones you're looking at, but I know those are
So
the
the one, so my big part that I'm looking at is basically this. If you look at Bitcoin spot from a weekly perspective, you had these tremendous wicks in price. Just the body stayed in a very tight range for a couple of weeks, from 38,400 till 37,600. The
Yeah.
moment
I
the moment I see weeklies close from a body perspective below this range, this is where I feel there's going to be some momentum, stronger momentum towards the downside, if I could call it that way.
Yeah, man. It's you just put me in a very weird position, a strange position where I don't know if I should speak out or not because I'm. How can I say that? It's just that I expect sub 30K. So take
Yeah,
it
yeah,
as you
yeah.
wish. But
Yeah. Me too. I expect that. I expect it. But just for the sake of conversation, you know what I mean? Like we go level by level. I
yeah,
mean,
yeah,
and this is why, like, if I expected for us to go, how can I say this? Uh, 30K to 20, let's say 25,000 from this level right now. I mean, I wouldn't put 20% risk. I might have put
no, yeah, of
200%
course.
short. You know what I mean? Since
Yeah, yeah. If
since
if if
those
you were
things
sure.
exactly, but since those things are very unpredictable, let's just say my bias towards the downside would substantially increase if we go below that level, or especially if we go below, retest it and get rejected. That's where I'm adding to my short. Like that's for me is a key
Yeah.
level.
And I know we are kind of getting close to